Welcome back, guys. In this video, we'll be discussing about fundamental analysis part 2. In the last video, I was explaining about profit and loss statement and how we can use profit and loss statement in order to judge a company. So if the revenues are rising, the net profits, the PAT, the profit of tax is increasing year on year, and you can actually calculate with the help of Excel sheet what is the percentage change per year. And if you see any consistency kind of a thing in PAT, you can definitely go for a company like that. Now, let's continue our topic, and in this video, we'll focus on balance sheet and cash flow statement. So, balance sheet, let me give you an overall view. What is balance sheet? So, for example, let's consider an household. So, in a household, you know, your father, let's assume your father is the breadwinner of the family. So, how you will judge that how much net worth like your father's having? Will be definitely somewhere around whatever asset he's owning right now at any particular point of time, and the assets and the liabilities, whatever he has to repay. So the assets minus liabilities will be the net worth of a household. Okay? But in case of companies, the balance sheet explains the net worth of business in such a way that the assets are equal to the liability. Then, like before, I was telling that assets minus liability is the net worth of a household, but here I'm telling that asset is equals to liability in case of a company. Why is it so? Uh, you know, in point of view of accounts, they like a business is a separate entity, is a separate entity. In what sense that whatever capital that owner also invest in a business, from a point of view from business side, you can see that business is considering it a liability, that the business has to repay this particular amount to the owner back at some point of time. That's how that's how the business consider it as liability. So whatever I'm putting my money into the business is a liability for the business. And for example, I am a shop owner. Okay, so I invested 10 lakh rupees setting up a shop. So, in the books of accounts, what it will show that the liability of the business is 10 lakhs that from the shareholder. So, I am like it's my equity, right? It's my equity in the business. So, 10 lakh rupees is the liability. And for example, I'm spending that amount on furniture and rent, or acquiring that particular piece of land or building. So that'll be an asset for the company. Or for example, I'm buying some inventory so that I can sell from my shop these particular inventory. So that is asset for me. So liabilities is equal to asset. Now in the case of companies, liabilities have two parts. One is the equity part and one is the liability part. So what is so liability? I'm here stating about the non-current liability and the current liability. So what is non-current liability and current liability? Non-current liability, imagine your father has to repay a home loan, but the term for the loan is of 5 years. So he doesn't have to repay like the full amount in 1 year. So that will be a non-current liability that I have to pay this much amount, but not in this year. So if the liability is for more than a year, then it is considered as non-current liability, and if the liability is for less than 1 year, then it is considered as current liability. For example, when I'm setting my shop, I'm buying goods, I'm buying inventory on credit basis, but I'll be repaying that amount of money to my creditors in a year because I want the inventory again and again. In order to continue that cycle, I have to repay that amount within a year. So in that case, I will be considering in my books of account this as current liability. So now I think liability part is kind of, I think it is clear by the example that I'm trying to give. So current liability, non-current liability, and this third component. So the third component is shareholder equity. So the example I was giving previously, the 10 lakhs of money that I put into the business, that'll be the equity of the business. So equity plus non-current liability that I have to pay to the outsiders, and like I don't have to pay it immediately, and the current liability that I have to pay immediately, but like in 1 year, in less than 1 year. So that is about liability, and it is equal to asset. So all that liability part, whatever I'm trying to get from the outside public and from the shareholder or from the creditors, this type of money I'm spending on asset. So asset is like land, machine, building, inventory. So inventory, if it is, inventory is current is considered as current asset because every time you will be purchasing that inventory and you'll be selling it. So, but if it is, if you are producing some inventory, for example, you are a factory owner. So, and if your stocks or your inventory, whatever goods you are producing, you get sold within a year, that will be a current asset. And if it takes more than a year, so if there is heavy equipment production you are doing, and it takes usually 2 to 3 years to sell particular equipment or some particular big machine, so that will be considered as my non-current asset. Still, it will be considered as inventory. So I think I'm clear about that. So whatever liability, the at the end of the day, I'll be putting it to the assets, and with the help of assets, I'll be able to, operate my business, create some kind of revenue, and that will be a part of profit and loss statement. And profit and loss statement, at the end of the day, I'll be doing some expenditure, I'll be earning some kind of income, and the expenditure, so income minus the expenditure will help me, in getting my operating profits, and deducting the profits and the depreciation. All those things will be my net profit after tax, or PAT, profit after tax, and that will be considered. And again, for example, if that profit after tax, whatever, in a year I sold, 1 crore rupees of inventory, I incurred 90 lakhs rupees of expenditure, 10 lakhs is my profit. As a sole proprietor, I can take that 10 lakh rupees to my home. But what companies would do instead is they would try to, expand their business. They'll do something, like, they can give this amount of money for financing activities. They can give out loans so that they can earn some kind of interest, and they can do, many things with that money. So they can go for, they can go for dividends as well. They can give the company, for example, I'm taking the profits at my home, that will be considered as dividend in this case. So in the last video, I was telling you that directly we'll go to the company's profit and loss statement and try to analyze what type of business a company is into. So let's delve into it. I'll just go to, okay, we will consider. So this is DMart. So DMart is, is a national supermarket chain. Like they sell, FMCG products, and it has been established from a very long time. And the current revenue of this business FY23 is 31,000 crore rupees. The market capitalization first. We'll try to see what is the market cap. So it is a huge company, uh, like 3,24,000 crore rupees, and the revenue. Let me try to see what is the revenue of this business. Again, analyzing the profit and loss statement. So the sales of this business is continuously growing, and you can see it's an upward trend. If I try to plot this on Excel sheet, I'll be getting a upward graph, and there's no kind of revenue fluctuations. And same in the case of net profit. Yes, this is continuously increasing year on year. This was a drop in the profits because obviously this was a COVID year. Yeah. So, and otherwise, you can see that the profits are increasing, the revenues are increasing, and you can take out the percentage change in the net profits, and you can see what is the compounded profit growth. So, in the last 10 years, the compounded profit growth is 32%, which is very good. You should consider, a compounded profit growth of 20% over the 10 years is a very good rule of thumb, which you can use in order to analyze a company. So this I used with the help of screener. Okay, this okay. I'll try. This is consolidated figures. Okay, and actually what they're using in screener is nothing less than, they are just trying to get into the balance sheet from their side. Yeah, they're taking the balance sheet of October 14, 2023, and they're taking the data from here. So we don't need to worry about, from exactly where the screener is getting the data, because we should absolutely trust to the primary source, that is annual reports from the company's website. But this particular website is taking directly the data from the annual reports of the company from the website, I hope, and you can rely on this. So yeah, that is a good. This is a good to go, analysis that you can use in order to analyze a company using profit and loss statement. Let's continue to our topic. Uh, so balance sheet analysis. So I was talking about the components: asset, liabilities, shareholders. So the asset is equals to the liabilities plus the shareholders' equity. And the purpose is to assess the financial health and stability of a company. Imagine a company where the balance sheet is fluctuating. Some year they are having asset worth, full asset worth of 1 lakh crore. Another year they have 50,000 crore. Another year they have 2 lakh crore. So this, you don't want to be invested into that business where the balance sheet of a company is fluctuating a lot, be it whatever reason, because at the end of the day, the company's market capitalization will be decided on those topics. So if the company is, continuously generating huge amount of net profit, and they're able to, and the net profit is again added to, surplus in a liability. So again, that it is considered, it will be added in the equity side and the reserves and surplus. So liability again. So how exactly that actually I'll delve into the balance sheet, and then I'll try to justify why is it so. So structure, it's divided into two main sections: assets and the liabilities and equity together. And the significance is it's essential for investors, creditors, and management to make informed decisions with the help of balance sheet. So what is the asset overview? There are current assets, there are non-current assets. Okay, just two type of assets. Current assets expected to be converted into cash within a year, be it in cash that is sitting into my bank accounts, and be it account receivables, the amount of money that I have to receive from my debtors. And non-current assets, it includes long-term investments. So these investments are usually in order to have, these investments business do for long-term, for the operation activity, mainly for the operation activity. But if some business is into, giving credit, as per say, on a long-term basis, so that will be considered into non-current assets. So it indicates the company's ability to generate future cash flows. So actually, cash flow itself is it's a great tool for financial analysis of a company. And in the later section, you will be able to see that just looking at the cash flow of a company, you should first consider that matrix to be the most important, because a company can lie with the data on balance sheet and profit and loss, but they cannot lie with the cash flow, because that is the amount of money that is into the accounts, the bank accounts. So because the auditors will be they'll be 100% responsible if there's any kind of miscalculation that is presented into the cash flow statement or the balance sheet. So you have to first look into the cash flow, according to me, and then, and how exactly to look into, I'll delve into the later part. But as of now, you understand that this is also a very important thing, because at the end of the day, balance sheet is what it matters. Like it matters a lot, because if a company is able to grow at a particular rate, and if they have humongous profits, if they are investing continuously into non-current assets, and which is visible into the operations of the company. So, the current assets consist of inventory, account receivable, prepaid expenses. So the expenses, payments made in advance for goods and services to be received in future. You're buying some kind of thing, and you did the payment in advance. So that is prepaid expense, and that is again considered as a current asset. So cash and the cash equivalent I was telling about, and account receivable, the amount of money that you have to receive from the debtors of the company. You sold some goods and you're yet to receive the payment. But according to the non-accrual basis, you will be, considering it in the balance sheet before the actually transaction is realized. So you don't need to wait for the cash to come in and then you will have to record it in the balance sheet. You can just record it as soon as the transaction is, the transaction between the parties is kind of formal, and it's kind of legitimate that okay, the transaction is going to happen. So what a detailed look at the non-current assets. So the now we'll look into non-current assets. So these are, assets which is patents. It can be tangible, it can be intangible. So intangible assets are like goodwill of a company. So, for example, goodwill of a company is I have acquired a particular company, let's say, Haldiram, at a valuation of 1 lakh crore, but like there's another buyer which wants to buy Haldiram. So imagine like I acquired it on 1 lakh crore, then I'm selling this particular Haldiram to 1,50,000 crore rupees just because it's Haldiram, the brand name. So that will be the goodwill part of the company. 50,000 crores is the goodwill that will be registered in the books of accounts. So patents, trademarks, these are intangible assets that a company owns. So the pharmaceutical companies, they have a lot of patents because like they'll be producing a lot of drugs, and they'll be inventing a lot of drugs which will cure many of the diseases that are present. So long-term investments. So long-term investments that the company intends to hold for more than a year. I'm investing in some kind of plant and machinery, heavy equipment in order to, do my operations in the business. That'll be long-term investments. Depreciation. So it's deducted from the asset. So sorry. So depreciation means allocation of the cost of tangible assets over their useful life. So imagine I was giving you in the previous, imagine an example where I was giving you in the previous video that you bought some kind of machine for 10 lakh rupees, and you think that the machine is going to go obsolete in 10 years. So you'll be deducting 10,000 rupees per year, and that will be the depreciation that is again deducted from the non-current assets. So take a look at this example. So the total current assets plus the total non-current assets will be equal to my total assets. So current assets will be somewhere around, cash and cash equivalent, market securities, inventories, trade receivable, and property, plant equipment, intangible assets, trade and other receivables, and goodwill. This is considered, so the total of it is total assets. And liabilities overview, again, it is divided into three subsections. Current liabilities. Oh, so liabilities is just two sections, and liabilities and equities together is equals to assets. So liabilities will be current liabilities and non-current liabilities. Current liabilities that you have to repay within 1 year. Non-current liabilities are the liabilities that you can repay in more than 1 year, and it indicates the company's financial position and risk level. And account payable, detailed look at the current liabilities, money owed to suppliers for products or services received. So we'll look at detailed current liabilities. So the loans and borrowings due within a year, that is all called current liabilities, and the other current liabilities includes accrued expenses and tax liabilities. So these are the liabilities that you have to repay tax in, in the other year you have to repay taxes. So that'll be considered, and this will be tax liability. So you have to pay to the government, and it is within a year because tax you have to pay tax every year, right? So that will be considered as tax liabilities. And current portion of long term debt, the portion of long term debt due within the next year. So the portion of long term debt due within a year. So you have taken home loan as say for 5 years, and you know it is again a non-current liability because the loan will be running for next 5 years. Well, for a company, let's say they have taken a loan for machine. So in the long term they have to repay the amount for that machine for 5 years, uh, like on EMI basis. 5 lakh rupees, like one lakh rupees per year. So, but the portion of long-term debt due within the next year. So now again, the next year I have to repay 1 lakh rupees. So that portion will be considered as current liability. The rest portion will be considered as long-term liability, non-current liability. So non-current liabilities is loans and borrowings due not within not due within the year. Deferred tax liabilities, tax owed due to timing difference in accounting. So you have to, I guess, the accounting period is 31st March, and somehow like you were able to come up with all this tax liability after that particular day. So like, you miss that chance of paying that tax within a year. So now that will be considered as non-current liability, because this is the liability that you because of the timing difference you in accounting. Your firm is accounting, you have financial year of from May, but the tax was due in March, because according to the standards they have to be repaid till 31st March. But because of this timing difference, that'll be considered as non-current liability. Other long-term liabilities, any of the long-term financial obligations, you have taken some kind of loan, that'll be considered long-term liability. Bond payable. So, companies, we have Adani ka bond, we have Reliance ka bond, we have many of the companies, REC ka bond, PFC ka bond. So these are long-term debt securities. You can just, buy these the debt securities from them, and they will offer you a good percentage, like 4, 5, 7, 7, 8% ka interest per annum. And but those bonds will be for like more than a year or 2 years, 5 years bonds. So in that case, there'll be a long-term debt for the business, because at the end of the day, it's not the business money. It's the money of the outsiders that they have to repay at certain point of time. But just because it is, it's more than a year, it's considered as non-current liability. So this is how liability cost statement looks in the balance sheet. We saw the so we in accounts we use vertical balance sheet, vertical type of balance sheet. Assets will be written first and the liabilities. So I'll just show you. Give me a minute. So what I'm interested in finding is consolidated balance sheet. So it has given, quarter wise, uh, this financial statement. And yeah, year 2024, year ending 2023. So these are the 2 years ka this financial statement you're getting. And this is profit and loss account. So this is how actually a profit and loss statement looks like. And yeah, so you can see, and the revenue from operations of demand in 2023 it was like 42,000 crore rupees, and now it's like 50,000 some crore rupees. And what I was explaining you right here was balance sheet, right? So assets will be on the top and the liabilities will be at the bottom. So assets like this is an actual, What I'm showing you is an actual company financial statement from the investor relations. Like, so this is a primary source that you can just go and access. And the year ending, 23, 24, you can just see that the total non-current assets of DMart was like it includes property, capital, and work in progress. So this is the development that is working place. So for example, they are building some kind of supermarket in let's say in a new city, so that will be capital work in progress. So it is having some kind of worth, but there's the amount of expenditure that they have already incurred this year. So they are continuously increasing their projects. And DMart's business is some kind, as soon as you see some kind of any kind of DMart ka supermarket, they have actually owned that particular piece of land and the building. So they are not into rental business. So they don't want to incur the expenditure of a rent. So actually they are into real estate business. Real estate business with they because the property prices are increasing, and at the end of the day they are able to get more and more of revenue. So the you see the total current assets, capital work in progress, rights issue, goodwill, intangible assets. So these are considered as non-current assets. And investments. So these are investments for long term. Other non And if you want to go into the detail, you can actually go into the details. And cash and cash balance and equity side. So this is the shareholder come money, whatever. And it's a total equity outstanding. And this is the non-current liability. So I was talking about the lease liability. Okay, sorry. Lease liability is the liability which they have taken lease of some land and they have to repay some money. So this is lease, a rental, basically renting a land. And deferred tax liabilities, and these are current liabilities. So current tax liabilities, again, the accounting period was not matching with the 31st March taxation period in India. And now it is getting considered in current liability that they have to repay within 1 year. Okay, so this is about balance sheet. Let me again come back to where we were. Yes. So the shareholders' equity consists of share capital, reserves and surplus, and retained earnings. So share funds raised by issuing shares. So when a company goes for IPO or FPO, so this is the money. For example, they are taking the money. If some company is issuing, like there was a new company, MCure. So MCure Healthcare. So recently they got listed in the markets. So whatever amount of IPO that they are issuing, for example, 10,000 crore rupees. I don't know the particular size of that IPO, but let's assume 10,000 crore rupees. So at the end of the day, that share capital, whatever funds they're raising, they're using it into the company, be it in expanding their business or spending it on marketing or increasing the sales, increasing the distribution channel, or running the operations, or actually repaying some of the debts. People use the issuing shares, fundraising in variety of way. You need to go to the report, that DRHP report, where the company mentions where how it is going to use the funds that is getting raised. So that component is covered in the share capital. And reserves and surplus include retained earning and other reserves. So whatever example I was giving you, 1 lakh rupees, 1 crore rupees, I sold, and 90 lakh was my expenditure. So that was my income expenditure. My profit was 10 lakh rupees. So this 10 lakh rupees, if I'm again investing into the business, that is called retained earnings. So I'm retaining my earnings. So I'm not spending it anywhere. I'm again investing it into the business again. So that is again, it's added into the shareholders' equity, because at the end of the day, the shareholders' equity is getting, the price of the shareholders' equity is increasing if the company is making the money. And retained earnings, cumulative earnings retained in the business. So reserves and surplus, it includes retained earnings. Cumulative earnings retained in the business growth. So you can see that there was retained earning in stakeholders' equity. Let's move ahead. Analyzing balance sheet. So Liquidity analysis, assessing that the company's ability to meet the short-term obligations. How will be able to see let's see. So, for example, the company is having, the current liability of some amount. So, if we see the current liability and the company is having enough cash flow in order to, give away its current liability, that will be liquidity analysis. And the company is having enough, let's say, operate the revenue from operations, and the company is getting that much cash from the operation that it is able to, give away its non its current liabilities. Then the company is good to go, and you can invest into a company. Again, let's take an example from screener. Mm, okay. let's take let's take some random company. Mm, Structure pillars. So let me analyze Shakti Sugars in front of you. So, it's having zero pros, and it's having a lot of cons, earnings included and income included. That's okay, that's fine. But you need to have your own kind of art in order to analyze a company. Again, I'll show you how to do that. So let's see total liabilities. Okay, other liabilities, the short-term liabilities. So the company is having short-term liabilities of 98 crore rupees. So that is the amount of money that they have to repay this year. So what we'll see in liquidity analysis, that does the company is having enough money to repay its short-term liability? I think they'll be having enough money in order to, let's see the cash flow, overall cash flow. They're having actually less of cash and cash equivalent. Let's see cash flow from operating activities. Yes, they are having enough money to, they are having enough money from the operating activity itself in order to give away their short-term financial obligations. So they're having, what type of short-term loans? I actually forgot the amount. Again, I'll go ahead. Short-term borrowings for 98 crore rupees, and they're having 114 crore rupees of, operating activities, but cash from operating activities. Let's assume, but this was about cash flow statement, but I was checking because you have to, in order to understand about the liquidity analysis, you have to have knowledge of if the company is having enough money in order to pay its short-term obligation. You'll be able to do with the help of balance sheet and cash flow statement. So like they'll be having a crossover, for example, say uh, analysis. So I think Shakti Sugars was having enough cash liquidity. Evaluating the company's capacity to meet the long-term debts. Just a second. Yeah. So let's say what amount of long-term liability Shakti Sugar is having, and let's on the basis of that, let's try to delve into it. Okay, what are the other liabilities is the company is going to get bankrupt? Let's see. Long-term borrowings. The long-term borrowings of Shakti Sugars stands at 674 crore rupees, and the amount of let's say, oh, what was the ratio? Solvency analysis. Solvency. We'll just directly look into the solvency ratio. I think they have not given solvency ratio as one of the. In the ratio series, we'll try to, make a solvency ratio. As of now, Net income plus depreciation divided by total liabilities. So this is the formula of solvency ratio. So the amount of net income plus the depreciation. So net income in case of this, we'll be able to get it from the balance sheet that the net income they're having at the end of the day is like 129 crore rupees, and I think it's plus the depreciation. So 129 plus the depreciation. Let's take analysis of 23 because the data is given in, because 24 is yet to. So I'll again take consideration the net income of this year. 416 crore rupees was the profit before tax for the period for the period of 23 FY 23. 416 crores plus the depreciation. So the depreciation was 282. So 416 plus, let's say, 282. I'll be 698 crores. This amount is divided by the total liabilities. So the total liabilities in case of Shakti Sugars is on this particular year was 1,668. So it's divided by 1,668. That gives you a 0.41. So is it a good ratio? Let's see. The result of formula is expressed as a percentage with a higher percentage indicating a greater solvency. A company is considered financially strong if it achieves a solvency ratio exceeding 20%. So in the case of Shakti Sugars, actually this is a very good solvency company. It is indicating a 41 percentage solvency. So any amount which is greater than 20% will be considered as a so it's having actually solvency ratio quite good. And the next is financial flexibility, understanding the company's ability to adapt the financial adversities. So, financial adversities in the case of, for example, some kind of COVID situation happens, and will the company be able to sustain? So, in case of these things, we will analyze the long-term liability. Uh, the company's debt. So if the enough cash flow. So for example, if the company is having enough debt and at 8 percentage per annum, if it's able to return that amount of money. If the company is having, just assume if the company is having debt to equity less, if it is having less debt related to the equity, because at the end of the day the of the company will be able to repay. So debt to equity ratio will be somewhere, should be somewhere, yeah. So debt is here. Let's see, debt to equity. Yeah. So debt to equity. So debt to equity in this case is, so the debt to equity in this case is actually bad. The amount of debt Shakti Sugars is having is exceeding, is 773 crores is the debt of the business, and divided by the equity, which is not a good. So in case of solvency, or in case of this financial flexibility, Shakti Sugars is not very good company. So I'll see the equity of the company. So the equity of the company is okay. Yeah. So you can see the equity of company is just 119 and 119 crore. Imagine this. The company is having just 119 crore rupees of equity capital, and the company is having 600 crore rupees of debt. So it's very worse situation, because in case of any event like COVID, the company will not be able to repay debt even if or the owners of the business sell full of their equity. So this is a very, debt to equity is one of the financial ratios. So in the later series, we'll be considering ratios, how to judge a company on the basis of balance sheet. So the company is having ratios on balance sheet, on cash flow, on P&L. So understanding these financial ratios is very important. How did I come with this example of debt to equity? And I was able to see the debt, this debt was here of the company, and the equity I checked. And I was telling that this company won't be able to sustain a period like COVID, because in case of, for example, 10 years, if the business is not able to work, we have some kind of, a downturn in economy. So in that case, in that scenario, the shareholders will not be able to repay this amount of money. And the comparative analysis, you have to compare, balance sheet across different periods or with the industry peers. So in case of Shakti Sugars, you go with all the sugar companies that are listed in the stock markets, and the top sugar companies, and see what's the P ratio, how the companies, which company is better, which company is having better growth in the case of balance sheet, who's having less long-term obligation, who's having less debt to equity ratio. So these are the things that you have to look into the balance sheet, and you can with the help of this you'll be able to you'll be able to make your investment decision quite gratefully. You will think that, okay, these are all the things that I have to do in order to analyze a company. It will be too much hectic. Brother, you're investing your money into a company for long term. So you don't want to give away your money to someone who you don't trust to. If you trust a particular company, and you know that the company is doing operations in a very good manner, and the management is good, and the balance sheets, P&L, cash flow looks absolutely fantastic, you can just close your eyes and into the companies like that. You don't have to worry at the end of the day. And even if the company's, the price of the share falls down or the price of share goes up, you can just you can just average that particular share a lot many times, because you have trusted the financial statements of the company and you have analyzed it thoroughly. It won't take actually a day in order to analyze a company fully, that looking at all the aspects of it. Like, because there are tools which are very easily readily available, but you just need to understand the concepts, that what are the things that you have to look at the end of the day. Like, I'll try to make a financial ratio ka sheet, and there I'll be giving you some kind of threshold that you can just look at the ratios and see the thresholds. And if the company passes a threshold, you can just directly go and invest into it. And if they don't pass it, you just don't have to look at to the company, and you can look into another company for the same sector. If you want to have, you need to have that kind of insight, that what sector will be relevant for the next 30 years in Indian economy, 40 years, 50 years, 100 years down the line. And if you have that kind of, insight that, okay, this sector is not going to die. For example, let's say banking won't die in India. If our economy becomes from 3 trillion, 30 trillion, 100 years down the line, do you think that the banking financial sector won't play a role in it? All these transactions from 3 trillion to 30 trillion, there'll be lot of transactions happening. So I think that the financial sector in India, be it banking, finance, and BFCs, any kind of financial sector, will be in a very much boom over the next 50 years, 100 years down the line. So you need to analyze which particular segment you want to look into, be it non-banking finance companies, or be it into banking finance companies, or into insurance companies, or into some kind of these products, and list down all the companies, and see that each company, each competitor, the best company you choose, pick up, invest your money into it. That's how you do investing. You can do it for short term, this short term trading, for getting, and you can do it for long term as well. You can go for mid cap stocks, large cap stocks, small cap stocks. So if I didn't, and tell you the logics, I think I taught you the logic. Less than 5,000 crore rupees of market capitalization, small cap. So you can just target small cap companies, and small cap companies will give you a very heavy return if you have analyzed the company in a very good manner. And if you know that in and out of the company, you'll be able to make a good money out of small cap, mid cap companies, because most of the this quant mutual fund, like, they invest heavily on in small cap. They'll be able to do all of these. They'll be able to give 70%, 60% return, because they have a particular niche in investing. They know what exactly to look into the company. So can't we adopt the same? Definitely we can adopt the same. We just need to have some kind of, a sheet. There should be a structured manner. There should be a science behind it. Science means there should be, it should be universally correct for all the companies. The ratio should be available for all the companies. There should be a particular methodology. And if you are able to come up with a methodology, and you are able to, get succeed in investing, actually you can make a career out of investing. That's what Warren Buffett did. So there's nothing wrong in understanding these concepts. That's what I'm trying to say. Let's delve into cash flow analysis. To be very frank, this is the most important analysis. Consists of it has three components: financing activity, operating activity, investing activity. Let me tell you, part by part of it. A financial statement that provides aggregate data regarding all the cash inflows and outflows of a company. So whatever cash transactions the company is into, how much he paid to this, what is the bank, all the banking check the transactions, whatever is happening, where the company is, investing or, taking loan from somewhere or, getting money from the operations, whatever business it is into. That is about cash flow statements to provide insights into company's liquidity and solvency. It helps in assessing the company's ability to generate cash and fund its operations. So the company should be able to generate enough cash and fund its operations. Like the company should be able to fund whatever requirement it is having at any particular point of time. Want to set up a plant, an extra plant, you have enough cash, okay, you can go ahead with it. That is how, if it is directly flowing money into the investing activity, and it is able to give a huge amount of operation cash, like cash from operating activities. That is the company that you should be looking at. I'll be giving you granular detail about all these things. Importance of cash flow statement. It helps in understanding the company's ability to meet short-term obligations. So if you have some kind of money that you have to return within a year, so if you have enough cash in your bank, then only you will be able to repay it. If you don't have money sitting into your bank accounts, you won't be selling. Okay, I'll sell this plant in order to pay this much money, and I'll sell this land because this land is not getting used. And if you don't get the buyer, then these are the things that you should look at. And liquidity assessment help you in understanding, will the company be able to meet its financial obligations at the end of the day. It indicates the ability to alter amounts and timing of cash flows. So let's look at the performance and evaluation. It assists in evaluating the company's operating performance. So example, comparing cash flow from operation with net income. So if you compare the cash flow from operations with the net income, and you arrive at CFO, some CFO divided by net profit, this, and that particular financial ratio will be very helpful in assessing, will the co- is the com whatever net profit the company is earning at the end of the day, how much of that part is cash. So if the company is having more of it as cash, like the most of it as cash, then it's a very good situation, because any kind of situation, any kind of activity that the company want to invest in, they don't even have to second out that they don't have money, because whatever profits they're running, it's directly sitting into the bank accounts. So there are take an example of this Apple Incorporation. So the company is having huge amount of cash. They don't even know where to put that amount of cash, and they look for investing opportunities all over. But because they're having so much sales, be it in iPhone segment, be it in Mac segment, be it AirPods, be it iPad. So now it's Apple Vision Pro. So they are having a lot of products. They're earning a lot of money, but at the end of the day, all this money is sitting into all the net profits are converting, are at the end of the day, is into their bank accounts. This gives them upper hand, because at the end of the day, let's say they want to get into AI, they can hire you know thousands and thousands of people in less than no time, because they are having those much resources. If they want to create their own AI, now what we are thinking, that okay, the AI race has begun, and ChatGPT, OpenAI, Microsoft, and this Gemini from Google, so, and at the end of the day, this Apple can also come into this race within no time, because it's having that much amount of money. Performance evaluation. It assists in evaluating the company's operating performance. So it's the cash derived from operating activities, and comparing cash flow from operations with net income. So comparing the cash flow from the operations. So whatever money the company is getting just from the operations, just from the core business, divided with the net income, they'll give you that's what I was telling you, that they are having enough cash from the operating activity compared to the net income. It influences decision by showing actual cash availability, and you cannot lie. because that's what you can, showcase that your goodwill is this much amount of crores, and your current liability, non-current liability, your debt, your asset. You purchase land machinery of 10 crore rupees, you can show it 15 crore rupees. At the end of the day, no one is going to value that, and under the table, whatever transaction you are doing, you won't be able to justify. But cash you cannot lie. That is why it's the most important component here. The cash flow directly related to an earning income, cash receipts from sales of goods and services. This is the operating activity. Investing activity is cash flows from the acquisition and disposal of long-term assets. So whether you're buying some kind of plant machinery equipment, or you know you're giving away disposal of long-term assets and investments. You're selling some kind of thing, or you're buying some kind of assets. That is about investing. And financing, cash flows from transactions with the company's owners and creditors. You are taking loan, maybe you're giving loans. So these are included. And so I think I'm clear, right? Operating activities, core operation, money, whether you are making a loss, whether you are giving the whether you are making enough operations that you are able positive cash flow. That is operating. Investing, you are either you are spending money on buying plant machine equipment, or you're selling them and you're making money from there. And financing activity, while either you're taking credit or you're giving credit, that is involved in financing activity. So cash flow from operating activity. So there's two methods, direct method and indirect method. Cash received from customers, cash paid to suppliers. This is a direct method. And depreciation, changes in working capital. This is indirect method. So yeah, it's recorded in two. There are two methods. List major of, so this direct method, there's the indirect method, and cash flow from operating activities. Looking at all these small details in the balance sheet itself. For example, you want to check that what this particular cash from investing, where actually did the company went for the investing. You can actually look at the citations. You can look for the citations in the reference section, and you can look where exactly the company has giving full details about it, and you'll be able to figure it out. But I'll try to make it easier for you. Cash from investing activities, again, we discussed, like I think I repeated it a lot of times, so I think you're clear of it. And cash flow issues and solutions. So negative cash flow indicates more cash is going out than coming in. Let me take an example of it actually. Uh, you know, I think it's too much theoretical. Let me go to the practical. Uh, let's again take, uh, yes, add this all figure. So cash from operating activities, just who will type all of that honestly. So it gives you 827. Okay. So this is the cash from operating activities that Shakti Sugars has, done from the last 10 years. है ना? Let's take investing activity, and this. So this is 351 crore. Let's add the financing activity. So now I will tell you what I was doing. So they are generating 827 crore rupees from core operations. They are having sugar mills, maybe they are selling all these, they're producing, and all this expenditure removing. At the end of the day, from last 10 years, overall they got 827 crore rupees. How much they invested in the, maybe it in plant, machine equipments, whatever be it. So they have invested 351 crore rupees. Okay, so now like that's a good thing, right? 351 crore rupees they have invested, and they are able to. But first thing, when you're looking at operate, I forgot that point actually. You look at these figures, up and down. It's a negative 2015, negative 43. You know, it's increasing, decreasing, increasing. ठीक है? It's increasing, increasing, increasing. But this is the first red flag that I'll see. The graph should be full upwards. Okay, I'll just take one exception, 2019, 2021, whatever this is, like 2020, let's say 2021. But the companies are already having negative cash flow from operations from the in 2015, 2018. This is not a good sign, right? Like maybe this year the business was, that was booming. Another year the business is doing bad. First red flag. You don't have to even look at into the company now. I will leave this company actually. I'll take another company because I will not be investing my any penny to a company who's having, not a short business where the company is having, it's not having enough strength. Let me take a good example. Let's see the cash from operating activities ka chart here. Okay, again they are also not consistent. So they're not have, but where exactly they're using the money, that is quite. But you see the cash from operating activities. You sum up all of this, the amount of money that they have produced. Like okay, it's good. But again, the chart is not consistent. So like one negative point. So 30,000 crore rupees from operation activities just by selling paint, they have made money. Okay, let's said what amount of money that they did put into the business. They put in like 10,000 crores. So 10,000 crore rupees they invest into the business, and they're able to make money of like uh, up about like 30,000 crore rupees of money. That is a good amount. Let's take financing activity. How much of the company, like how much does the company, took loan from outside, and what it has to repay. So if you look overall, they just need to return like 16,000 crores, oddly 16,000 crore rupees of money, and they are having like in 10 years down the line. Let's assume that, let's total all the figure, and let's see from the last 10 years how the company is doing. So they have to return just 16,000 crore rupees of money to the outsiders, and they are able to generate 30,000 crore rupees from the operations. So even if they are able to, even if they are able to repay all of that money, they are actually happily. Let's assume there's 8% interest rate on an amount of this, and they are having 10,000 crore rupees of 16,000 crore rupees of long-term debt. So there's having companies having good pros and good cons. You don't have to look pros and cons. Just ignore the screen at that part, because here it comes about you, that how you do it better than anyone. Let's again. I'll take new chat so that the figures and this all this investor relations. Yeah. Let's see what is the cash from operation activities from the last 10 years of Adani. These. They generated cash from operating activities 75,000 crore rupees from the last 10 years. How much they invested in? I think they invested a huge amount, and after that Hindenburg report, they repaid a lot of debt. So this is the amount that they did put into the business, like be it setting up ports or whatever. So 68,000 crore rupees they went into it went investing into the business. Let's say financing activity. How much of how much of loan they so if it is a negative figure that the company owes to the outside, that's simply yeah. So there'll be a total of 5,920 crore. So how much company has to repay? 5,920 crores only. And how much from the last 10 years, I'm telling. And how much, yeah, am I wrong? No, I'm not wrong. Yeah. And 75,000 crore rupees they're able to get from the operations. Let's assume again the 10% interest rate wala hisab. Uh, let's say 592 crore they have to repay. 592 crore they have to repay if they are paying interest of on this 5,000 crore rupees. They have to repay 592 crore rupees. And in the last, let's see, in the last year, how much cash from operating activity you see? 15,000 crore rupees of cash from operating activity they are having, and they just need to repay in interest 592 crores. The company is having enough liquidity, to repay the interest for I think next 20 years. They're having enough money. So 10 years will be like 5,000 crores, and another 10 years will be 10,000 crores. Even if they have the same financing activity figure, they're able to repay. They'll be able to repay it with from from the March 2024 ka operating activity. So you see, and the cash from operating activity, you see this positive sign. 5, 6, 7, 10, 11, 15. These are the companies that you have to look in. Now the first check is cash flow. If the cash flow is approved, you go to P&L. If the net profit is increasing, regularly, consistently, approved. Balance sheet. You have to look into like what type of actually the debt depends on the business. If the company is having zero debt, just blindly go for that company. Don't even look at here and there. It's fundamentally very sound company. At whatever price you're getting the company for, just go for it. And here, if the company, for example, this company will be having some kind of debt, because they are into huge capital expenditure business. Building ports is not, it's not a cup of tea. It's not anyone's cup of tea actually. How is Adani able to do it? God knows. So at the end of the day, if the balance sheet, P&L, cash flow, they align in such a way that the companies look financially very strong, you can go ahead and invest into the companies. So this is for today the cash flow statement analysis, and hopefully I was able to deliver whatever I was trying to convey. You need to look into all these. So we discussed P&L, we discussed balance sheet, we discussed cash flow. In the later part, we'll try to discuss ratios. So ratios will help you in actually if I make a set of ratios ka sheet, and whenever you are trying to invest into a company, you tick mark all of those things. And if you are able to tick mark all of those things for a company, then it will be a good to go company. But first I'll teach you which ratio tells what. You need to understand it and then tick mark it, not just blindly go and okay, I said it just because. So you need to have concepts very clear. I think today I was able to say whatever I was trying to I was able to convey whatever I was trying to say, because you know this is what you should look for. The operating activities, cash, if you're getting enough cash. The financing activity, you sum it up, how much interest they have to repay. If the interest rate calculation is fixed, and be it if the company is heavily investing, and if the investing amount, if let's say it's less than the operating activity, that means they're able to have enough cash that from operating activity, that they are able to build upon the plants, machines, and equipments, just on the basis of the cash flowing from the operations. That is a good company, right? The company is reinvesting. That's what the company is trying to say. So this is from my side. Thank you for watching, and stay tuned for more videos.